All right, today we're diving into a company called Sterlite Technologies, or STL. Now, these guys are a huge deal in the fiber optics industry. You know, the cables that are the literal backbone of our internet. But here's the thing. Even though they're a titan in their home market, their story gets really puzzling. It's a real tale of two companies in one. So this is the big question we're trying to wrap our heads around. How can a company be a clear leader in its field, and yet, somehow, be struggling big time? It's a total paradox. And to figure it out, we've got to look at the two completely opposite stories of Sterlite.
Okay, first up, let's look at the good news. And it starts with just how dominant STL is on its home turf in India.
In India, Sterlite is number one. Full stop. They are the biggest maker of optical fiber and cables, period. And a big reason why is something called backward integration. Now, what that really means is they own their entire supply chain, from the raw materials all the way to the finished cable. That makes them one of the lowest cost producers out there, which is a massive, massive advantage.
So with that in mind, let's build what you might call the bull case for Sterlite. What are the key strengths that have investors feeling optimistic about the company?
So when you look at their finances, a few good things really jump out. First, they've been paying down their debt, which is always a healthy sign. We already know they're a low-cost leader. And maybe most importantly, they've gotten way, way better at actually collecting the money that customers owe them. Get this, 75.4 days. That's how long it takes Sterlite, on average, to get paid after they make a sale. Not too long ago, that number was 105 days. Think about that. They've shaved a whole month off their waiting time. For a company's cash flow, that's like a huge shot of adrenaline. So, a low-cost leader in its home country, getting its finances in better shape, what's not to like, right? Well, this is exactly where the story cracks in two. Because the moment you zoom out from India, a totally different and frankly, a much more worrying picture starts to form. Okay, now for the other side of the coin. Let's dig into the concerning trends, the bear case for Sterlite. And here is the first huge red flag. If you look at the global market outside of China, Sterlite's market share has just collapsed. In a single year, it dropped from 12% all the way down to 8%. They lost a third of their international market share in just 12 months. That is a massive hit. And this isn't just a one-year problem. If you look at their sales over the last 5 years, they've actually been shrinking by almost 5% every single year on average. This is a company that's consistently selling less over the long run, not more. Now, to really understand this next number, we need to quickly talk about something called return on equity, or ROE. Don't worry, it's simple. All it asks is, for every dollar shareholders have put into the company, how much profit does the company make back for them? Positive is good. Negative? Well, that's a huge problem. And here it is. Sterlite's ROE last year was negative 6.28%. That means for every $100 that shareholders invested, the company didn't make a profit. It actually lost $6.28. From an owner's point of view, the business is going backwards. So who actually owns this company? You can see the founders or promoters still have the biggest slice, over 44%. But honestly, the most interesting part isn't who owns what right now, it's how that ownership has been changing over time. And here's the trend that should make you sit up and pay attention. The promoters, the ultimate insiders who know the company better than anyone, have sold off nearly 10% of their stake in just the last 3 years. You just have to ask yourself, what did they know that's making them sell? Okay, so we've got these two totally different stories. To really see which one is telling the truth right now, we need to zoom right in on the most recent financial numbers. And wow, the latest quarterly numbers, honestly, they show a company in free fall. Just look at the sales. In 1 year, they were slashed by more than half. But the bottom line is even scarier. They went from a 63 crore rupee profit to an 82 crore loss. That is a shocking turnaround in just a handful of months. And zooming out to the yearly numbers, it's just as bad. Back in 2019, Sterlite was doing great, making almost 600 crore in profit. By 2023, that had shrunk to just 127 crore. And this last year, they didn't just make less profit, they actually lost 57 crore. that trend line is only going in one direction. So after all that, where does this leave Sterlite Technologies? Let's put these two conflicting narratives right next to each other to see it clearly.
Really all boils down to this. On one hand, you have the bull case, a low-cost champion in India that's improving its finances. But on the other hand, you have the bear case, a company whose global market share is evaporating, with shrinking sales, growing losses, and insiders who seem to be cashing out.
And so we're left with this question. Can Sterlite leverage its strength at home and its low-cost base to rebuild and come back stronger on the world stage? Or are we just watching the slow, painful decline of a once dominant player? Is this a major turning point, or is it the beginning of the end? That is the billion-dollar question.